here we are. We're going to do a quick little video for folks out there because I had some great questions that came up this week that I think you can help me with. So I'm Marie Jacobs, and I'm with Sotheby's Realty. And with me, I have one of the smartest financial guys on the planet,
Shucks.
as far as I'm concerned. That's Brady Mullen. And Brady has done a number of classes that I have learned so much from you, Brady. And I am so excited to be able to do these little short videos so that we can kind of tell the world what's going on and how to make the most out of investing in real estate. And I think that's just such a gift you have.
Well, thank you.
So today
I
I have a question. I wish I knew this stuff when I was in my 20s and 30s and taking advantage of it. So, my goal in working in real estate is to help people to do this and do it sooner than I did it. And you've been such a big helpful part of that in helping me to help others get educated on how to do this when you're younger. I was making a lot of money and I was traveling and having a great time, but I could have taken just a little bit and scrolled it away and started buying properties 20, 30 years ago. But I started doing it only 10 years ago. And now I have 3 properties, and it's remarkable how fast this goes when you look in terms of the equity and appreciation in these properties. And what I thought about, like when I bought my first one in 2012, I never thought that thing was going to be worth 100% more than the appreciation was going to be 100% on that property 10 years later. And even now, and I've taken your classes and looked 30 years ahead at what that looks like. In 10 years, I've doubled the value of one of my properties, and that's where my debt equity is sitting. So now I want to take that money and put it into yet another property, a 4th property, so that one of them we live in, 2 of them we rent, and then I'll have a 3rd rental. And it's going to more than triple the value over only a few short years because of how our market continues to appreciate.
Yeah, I couldn't agree more. And even if, there's some data people out there, or, you can basically search for anything you want on YouTube and find it. So you'll find people that say, oh, the market's going to crash, it's going to go nuts, this is changing, Bitcoin's going to be the new currency for the world, and blah, blah, blah. And I take the position of it kind of doesn't matter. We're dealing with real estate is like at the very bottom of Maslow's hierarchy of needs. I just can't imagine a scenario where people aren't going to pay money to live indoors. That's just going to happen. So if the market, I can't imagine the market correcting along the Front Range anytime soon because there's not enough inventory, and it's not something that people can do without. People have to live indoors. So I don't predict a correction, but if I'm wrong, if Denver becomes an undesirable place to live for some reason that I don't understand yet, I don't know the future. However, if you have a long-term perspective and you buy something, if you look at nice properties in the Denver metro area, and you tell me that 5 years from now it will be worth less than it is today, and people will spend less on rent than they do today, then we're just not seeing eye to eye on that. I just don't believe that. Now, in the next 6 months, could there be some sort of weird anomaly, or sometime in the next 5 years, could something happen? Sure. I'm not saying.
But even when it has, like when 2009 happened, we lost our market 5 to 10%, where the rest of the country was losing 50 and more percent. And the very next year, it went up 20%. So, it was a crisis for a year. But if you're holding, most people are holding their real estate investments. And speaking about inventory, again, I listened to the Altos March report, Altos Research, and it's true what you said. Inventory is still really tough, even though the impression in the market is, oh, there must be more inventory because prices are coming down on properties. The reason the prices are coming down in some markets is because interest rate is high. So people need to have, the sellers are having to come down so that the buyers can afford to buy. But in our market, again, it's not happening because inventory is off 50%. So there's still way more buyers out there. Everybody's got buyers, and there aren't enough listings to sell. So we're still having properties that are having competitive bids on them. Now, last spring, it was crazy. People were paying $100,000 over market value for houses. We're not seeing that kind of craziness, which is good because that indicates that the market is healing and it will help to curb inflation. But we're still short on inventory because people don't want to let go of their homes that have 3%
Yeah.
and less mortgages. So that's part of the problem. But there is a way to mitigate that and still earn more, even paying 6.5%. Just as you discussed, buy two properties, buy an investment property and a home for yourself, make it two investments rather than one, and have both of those appreciating at the same pace.
Yeah, and because interest rates are so salient, everybody tends to focus on that. And again, I'm not saying that they don't matter, but they don't matter as much as people often think. But think about it. If you buy a property at, let's say you get a 7% rate or something, I'm just picking a round number. If you get 7% rate on your property and in the next 6 months rates drop down to 5, what do you think that's going to do to the value of your property? That's going to flood the market with buyers, which economics 101, if you have a lot of buyers chasing the same asset, the value of your property is going to increase. And if you want to sell it, great. But it also allows you to refinance. You're going to gain all that equity when rates go down, and then you can simply refinance and be in the property at a 5% rate or whatever they drop to anyway. So you buy it at a time when everybody's kind of freaking out about rates, and then when rates go back and everybody's like, great, rates are at 5, I'm going to go get a house, or 4, or whatever they're comfortable with. And you're like, awesome, I already got this house. Now that the market is flooded with buyers, I'm enjoying a bunch of appreciation, and I'm going to refinance and get a 5% rate anyway. And if that doesn't happen, if rates keep going up, you're going to be glad that you got 7, because people are shopping
Right.
for houses at a 9%. So,
And if you turn that eventually into a rental property, rents are going up also. Rents are going up 5% a year. I just looked at those statistics. So your mortgage at 7% that you got 2 years ago is already going to be covered now, 2 years later, by the increase in rents. So you can turn around, take the equity out of it, go buy another house, and rent the one that you're in that you got that now rents have caught up to.
yeah, in a lot of the
Probably
calculations, oh, I apologize.
No, that's good.
In a lot of the calculations that I run, I show, if you buy, this is in the content about, you need to own your home instead of renting. And I show examples where, it's probably going to cost a little more on a monthly basis to own a property than to rent it right out of the gate, unless you put like 20% down. And most people don't do that for their first home. It's usually like 3% or 5% down. But in my calculations, I show that eventually you'll be spending less on a monthly basis to own your property instead of renting it. But I always use really conservative numbers to show where that crossover is, because in most circumstances, when you buy a home, you will notice within a few years that homes similar to the one that you own are renting for more than it cost you to pay the mortgage, especially if you've had a rate decrease and you're able to refinance. So it usually happens faster than I project. It usually happens within a few years where you're actually spending less on a monthly basis to buy the home by paying for it monthly on a mortgage than paying rent. So if you're going to be writing a check anyway, you'd rather write a smaller one, and it is smaller for the vast majority of your life if you're paying a mortgage instead of renting, because renting just keeps going up. So not only are you paying a smaller amount each month to live under a roof, you're also buying the property. So you're getting all of that equity. So if you're going to write a check, don't send it to the landlord, send it to the bank. Because on the mortgage, right? Get that equity building up in your name rather than buying the landlord an investment. Now, I'm not saying that renting is always wrong. There are times when we need to do that, right? If you're in a very transitional phase. I went through a divorce. I had to rent for a while just while things got ironed out. I'm glad there's a market for rentals. We need that as humans. But you want to get into the position of home ownership right away, as soon as possible, and then you can capitalize on the fact that it works the way that it does by owning the properties own a few of them. Try to make that a goal by the time you retire.
Well, that's great. Well, I think maybe
Well, that's great.
we've run out of time. And as usual, you have given me all kinds of new information. And I'm so grateful for you. And I'm so grateful for our listeners who get to reap the benefits of your wonderful financial knowledge.
Well, I
And
appreciate
I'll
that.
be excited to do this again next week.